What if I told you there are laws and plain sight laws that you think exist to protect you that actually guarantee banks always win? Laws that make risk almost irrelevant for them, while leaving you exposed, indebted, and powerless. Most people assume banks succeed because they are smart, or because the market rewards them. But the truth is far more insidious. The system itself, codified in statutes, regulations, and central banking policies, is designed to make failure almost impossible for financial institutions and virtually inevitable for the public. Today we're uncovering the hidden architecture that ensures banks always come out on top, no matter the crisis. We'll trace the origins, reveal the mechanisms, follow the cycles of collapse and bailout, and show how the pattern repeats even in the 21st century. By the end, you'll see why the game isn't about money. It's about power, law, and structure. Setting the stage, background, and key figures, 132 4 o'clock to understand how banks always win. We need to look at the intersection of law and finance. Banking isn't just about deposits and loans. It's a legal construct. Early European banks, particularly the Medici family in Renaissance Italy and the Rothschilds in 18th century Europe, mastered not just money, but legal frameworks. They realized that the law could be used to shield themselves from risk and amplify profits. When the Bank of England was founded in 1694, it wasn't merely a financial institution, it was a legal entity, with powers granted by Parliament. It could issue money, set interest, and effectively control credit. Over time, laws codified the privilege of banking, the ability to create money from nothing, to lend more than was deposited, and to externalize risk onto society. Central figures in this evolution include the architects of the Federal Reserve men, like Paul Vorburg and Nelson Aldrich, who brought these European models to the U.S. They didn't just want to regulate banks. They wanted to embed laws that made banks structurally advantaged in any economic scenario. The origins to 4 o'clock to 7 o'clock, the hidden laws didn't appear overnight. They evolved alongside crises, wars, and financial innovations. In the early 19th century, banks issued their own currencies. When a bank failed, its notes became worthless, devastating citizens. Governments gradually intervened, creating frameworks that protected banks against the consequences of failure. By the time the Federal Reserve was created in 1913, the legal foundation for perpetual banking advantage was solidified. Banks could now rely on central bank support, legal privileges, and a structured system that made certain types of failure nearly impossible for them. One key concept is limited liability. This law meant that when banks or bank executives made catastrophic mistakes, they could walk away without personal ruin. Contrast that with ordinary citizens who bear full responsibility for loans, mortgages, and even failed businesses. From the very beginning, the scales of risk were legally tilted in favor of financial institutions. The rise 7 o'clock to 10 o'clock, the 20th century saw these laws codified and expanded. Consider deposit insurance enacted after the Great Depression. On the surface, it was designed to protect citizens. But in practice, it created moral hazard. Banks knew deposits were guaranteed, so they could take on riskier ventures without fear of losing the public's money. Similarly, laws around derivative trading, shadow banking, and securitization gave banks extraordinary leverage. Legal structures allowed them to offload risk onto taxpayers and investors, while keeping profits in-house. By the 1970s, with deregulation and the end of the gold standard, these legal advantages became nearly absolute. Banks could create money, expand credit, and influence monetary policy, all under the protection of laws that ensured they rarely paid the full price for failure. The rise wasn't accidental, it was designed. Every new regulation, from the Gramm-Leach-Bliley Act to modern central banking policies, reinforced the notion banks are insulated from consequences, but citizens are not. The breaking point, 10 o'clock to 13 o'clock, the 2008 financial crisis, is the clearest example of these hidden laws in action. Banks took on extreme risk, bundling subprime mortgages into complex derivatives. The system collapsed, but the law guaranteed that banks would be rescued. Government bailouts, stimulus packages, and emergency lending weren't spontaneous acts of charity. They were legal mechanisms, ensuring that banks remained solvent. While citizens absorbed the costs through lost homes, jobs, and savings, the laws created a fail-safe for banks. When a citizen defaults, they face penalties, legal action, and credit damage. When a bank defaults, the system guarantees it will be made whole. The breaking point for ordinary people is often invisible, absorbed as debt or inflation, while banks continue to operate as if nothing happened. Fallout and failed fixes to 13 o'clock to 16 o'clock after each crisis. There is a wave of reform, new regulations, oversight committees, and public outrage. Yet almost all fixes fail to address the structural advantage banks enjoy under the law. Dodd-Frank, enacted after 2008, was widely celebrated as a reform. It imposed higher capital requirements and stress tests. But it didn't remove the implicit legal protections that guarantee banks can always access liquidity from central banks, and the fact that too big to fail still exists in practice. Meanwhile, ordinary citizens remain exposed. Personal debt skyrockets, bankruptcy laws favor creditors, and financial literacy programs cannot counteract the structural advantage baked into law. Banks continue to win not because they are smarter, but because the system itself is legally optimized for them to do so. Modern parallels to 16 o'clock to 19 o'clock. Fast forward to today, global banking is a $200 trillion industry. Fully digital, fully globalized, and still protected by the same structural laws that emerged centuries ago. Shockingly, the probability of a major bank failing without government intervention is virtually zero. Consider that during the COVID-19 pandemic, banks globally maintained stability. While citizens faced record unemployment, foreclosures, and rising debt, legal frameworks allowed banks to expand credit, manipulate interest rates, and absorb risk. Ordinary people bore the consequences of economic contraction. Even emerging technologies like algorithmic trading, blockchain-based finance, and central bank digital currencies are already being integrated within these legal frameworks, ensuring that the core advantage remains. Banks evolve, but the law continues to guarantee that they always have the upper hand. Patterns repeat: crisis, legal intervention, public cost, private gain. The cycle is almost predictable, and it is entirely legal. 3 clear takeaways to 19 o'clock to 2030 laws favor banks structurally, not incidentally. From limited liability to deposit insurance, legal frameworks were designed to protect institutions and offload risk to citizens. Crisis management is built into law. Bailouts, central bank support, and regulatory leniency ensure that failure is almost impossible for banks, but often catastrophic for the public. The cycle repeats predictably. Financial crises, government intervention, and public loss are recurring patterns baked into both finance and law, not anomalies. Warning, open-ended thought, 2030 to 2130. If you think banking laws exist purely to ensure stability or fairness, consider the evidence. Citizens are penalized for failure, while institutions are shielded by law. Every financial collapse reinforces this pattern. The real question, isn't whether banks can fail it, whether the system allows ordinary people to win, or even to participate on equal footing. As technology and globalization advance, legal protections for banks may become more sophisticated, invisible, and permanent. Will the average citizen ever be more than a participant in a game that guarantees someone else always wins? Call to action 2130 to 22 o'clock if this revelation reshapes how you think about money, finance, and law. Subscribe, hit the bell, and share this video. Understanding the hidden laws that govern our system is the first step toward reclaiming control and seeing the game for what it truly is.